Hello investors, thank you for joining me. My name is Michael from Deep Value Returns on Seeking Alpha. Today I want to talk about Apple. So Apple just reported a Q4 21 results. We're going to talk about its supply constraint problems. We're going to talk about its revenue growth rates. We're going to talk about what is Apple's underlying prospects really in earnest. Then we're going to talk about its capital return to shareholders, and finally we're going to talk about its valuation. So got a lot to get through, so I'm just going to jump right in. So since the summer, the stock has been on a tear, okay? So the whole thing about supply constraints and chip shortages have been well reported, and everyone has been aware of this, yet the stock had been rallying. So, on the back of that, the expectations were high, and they missed slightly by approximately 2% on the top line. So, the stock is down a little bit, marginally really, but because everyone knows this is kind of a temporary thing here. So they missed by approximately 1.6 billion on the top line, but ultimately, this is temporary, right? So if you think about it, since December 2017, Apple hasn't missed on top line. So every quarter since December 2017, Apple has just about met or surpassed analyst expectations. So this is a rare thing. Apple doesn't do many mishaps, and this is rare. So ultimately they're moving a product around the world, right? So it's a hardware product, and with all these kind of COVID restrictions and supply shortages in chips, it's temporary, I think. No, it's not a thing. It is temporary. So the top line was up 29% year over year. Obviously, there was the very easy comp with the previous year. How it fares up against the December this year is a different matter. They do talk about going forward that for this December quarter, it looks like it's going to be difficult for them. They're trying their best, but I think that it's going to be difficult to really smash through expectations meaningfully here. The other thing that I wanted to highlight is that, so if you look back to Q4 19, so look back 2 years, iPhone sales were down into 2020, okay? So they were down 21%, so obviously there was going to be a bounce up. So it was a bounce up from that point of 47% year over year. So it was always going to be quite promising against a slightly easier comp, right? But the thing I wanted to remind you is that 47% of what Apple's revenues come from the iPhone, okay? So services are big, but ultimately this is about iPhones. So I'll give you another context. So compared, if you think about it, right? Services are big. Services make up more than iPad and Mac sales together. But everything here is contingent on the funnel of the iPhone. The iPhone is the entry into the funnel of the Apple ecosystem. This needs to perform well for everything else to kind of work well as well. But as I said several times, I don't think this is a temporary thing, and I suspect that over the next 6 months this will be like yesterday's news. And one thing that I wanted to highlight, interestingly, so Apple is estimating that for its quarter going forward, it's going to be somewhere, the gross margin is going to be approximately somewhere around 42%. So this is towards the highest end of what it's been for some time. So even if supply constraints are weighing down on Apple, it still seems to be moving quite smoothly. And if you think about it, this is again the whole thesis: the services growing and expanding the margins, expanding gross margins. So even if there's kind of these minor mishaps along the way, this is not a thesis breaking moment. One of the things I wanted to note to you is that if you think about it, Apple has bought back 86 billion of its stock, okay? And Apple has noted that is looking to be cash flow neutral. So it has 66 billion of net cash once you subtract out the debt. They're going to be repurchasing this. They'll be using this capital to repurchase shares. And what you can see in this quarter that just went was that Apple's EPS was up 70% year over year. And right now, you're only paying 25 times forward earnings, not sales, but forward earnings for Apple. So they just reported 70% year-over-year growth, and you're just paying 25 times forward earnings. I think this is quite attractive. I don't think that investors are paying too much for one of the most followed companies in the world. But if you want to find out what kind of stocks I'm particularly interested in, because I'm typically much more invested in small cap stocks, and I want to help you become a better investor, don't forget to check out my marketplace called Deep Value Returns, where I give you high quality, actionable investment insights. Okay, see you soon. Bye bye.